Good evening and welcome to the Stanton Distinguished Leaders Series at the McDonough School of Business. I'm Rohan Williamson. I'm the dean here at the business school, and I'll also be your MC for the evening. At Georgetown McDonough School of Business, we are in the midst of celebrating our 60th anniversary. We are proud of our long tradition of educating students to become principled leaders with a global mindset in service to business and society. We are pleased that several years ago, dedicated Georgetown parents Dan and Mary Stanton established the Stanton Distinguished Speaker Series to help us achieve this mission. For more than 6 years, the series has brought leaders renowned in their fields to share their unique experiences with our community. Our ability to host a distinguished guest like John Waldron is invaluable to the educational experience at Georgetown McDonough. In fact, and as I just found out, the Stanton series emerged from an encounter that Dan himself had while he was an MBA student at Columbia, and that was with a speaker from Goldman Sachs. The inspiration that he derived from that encounter led to his career, which coincidentally started with Goldman Sachs. So maybe this is a trend that we're going to see here. So we're pleased to have Dan here this evening as our moderator. And just a bit about Dan. He founded Sampson Capital Advisors after a long career at Goldman Sachs, where he was a general partner and a managing director. He managed the firm's global private wealth management business, started and managed the global securities services business, and served as head of equities institutional sales in the United States. Dan also served on many firm-wide committees, including the Partnership Committee, European Management Committee, and the Pine Street Board. And of course, we also welcome John Waldron as our guest. John is co-head of the Investment Banking Division at Goldman Sachs. He serves on the Management Committee, Firm-Wide Capital Committee, Firm-Wide Client and Business Standards Committee, and the Investment Banking Division Executive Committee and Client and Business Standards Committee. Previously, John was Global Head of Investment Banking Services Client Coverage for the Investment Banking Division and had oversight of the IBS Leadership Group, a group he founded in 2010. Prior to that, he was Global Co-Head of the Financial Sponsors Group, Co-Head of Leverage Finance, and Co-Head of the Media and Entertainment Group. John joined Goldman Sachs in 2000 and was named Managing Director in 2001 and Partner in 2002. John is a member of several nonprofit boards, including the Lawrenceville School, Big Brothers Big Sisters of New York, Youth Incorporated, the Lincoln Center for the Performing Arts in New York City, and is a member of the Council on Foreign Relations. And I just found out that he's now on the board of his alma mater, Middlebury College. Congratulations. So please join me in welcoming John Waldron to Georgetown.
Well, thank you, Dean. My name's Dan Stanton, as the Dean said, and we're just going to have a little bit of a conversation with some questions. And we really want this to be interactive. I mean, this is for all of you. So we're going to get things going and talk about some things. Some of them are broader questions, industry questions. Some of them are questions that really pertain to your careers and the things you may be thinking about doing. So hopefully you'll find that they have some relevance. And we're going to get going for a little while, and then I'm going to turn it over to you for questions, and we'll just keep going that way. So let me kick it off. John has a lot of duties, but among them, he spends a tremendous amount of time traveling around the world, travels more than anyone I know, I think, seeing clients and CEOs in all corners of the globe. What are the most material changes that you've observed in terms of client behavior, and how does Goldman Sachs respond to those changes that you're hearing day in and day out?
So thank you for having me. I really appreciate the opportunity, and thank you, Dean, for such a warm welcome, and it's great to be on campus. Goldman Sachs has had a lot of success hiring Georgetown students, undergrad and graduate, and we hope that will continue. And so not to have a commercial about Goldman Sachs here, but if you're interested in Goldman Sachs, please grab me afterwards and stay in touch, because we've enjoyed our relationship with Georgetown and hope that continues as successfully as it has to this point. So to the question that Dan asked, I would say the financial crisis had a lot of impact in the world in various ways and shapes. To me, vis-a-vis our client base, which just to sort of take you through how we think about our client base, in investment banking, we spend time with corporations, global financial sponsors, or other financial players that are trying to invest capital in companies and in assets. Could be real estate, could be corporate, and governments. And increasingly, post the financial crisis, governments own more assets in the private sector. That wasn't the case as much prior to the financial crisis, but given the government's role in helping the world escape the financial crisis and recover from the financial crisis, governments now own more assets. So governments are an increasingly large client base for us. And as I think about the way, to your question, the clients have evolved kind of post-2008, I'd say a couple of things that are of interest. One is the focus on balance sheet and liquidity is now mission number one. And prior to 2008, when things were much more fluid and everything seemed like it was going really, really well, that wasn't as much the case. Anytime you have a crisis, and the same could be said perhaps for 1994, 1998, and other periods in our more recent history where there have been crises in the financial markets, all of a sudden the focus goes from growth and strategy and globalization and so forth, other things that you'll hear about that are still relevant, to balance sheet, liquidity, risk, protection, safety, survival, defensiveness, and so forth. And so I'd say that is the most prominent theme that has rippled through our client base post the financial crisis. Interestingly, I would say in the last 18 to 24 months, we've seen that intensive focus on risk and liquidity start to release a little bit, and we are starting to see behavior that is more like the behavior you typically see in rising markets and rising economies, where people are now becoming more offensive, more aggressive, a little less worried about liquidity and balance sheet, and a little more worried about some of the more offensive strategy, growth, globalization topics. So I would say we're in an interesting period where I'd say a shift from defense to offense again. Maybe we're getting a little later in the cycle. It may not feel that way because we haven't had this massive rebound from the financial crisis, but I'd say it's starting to feel a little bit later cycle, and that's probably the most prominent shift in the client's behaviors.
Let's talk about one thing in particular that has changed since the financial crisis over the last 8 years or so, and that's regulation. And there certainly has been a tremendous amount of discussion about regulation of Wall Street, but also regulation in other industries that must affect a lot of the companies that you visit and other financial sponsors that you referenced. Can you talk a little bit about how that's affected Goldman Sachs and what you see outside the walls of Goldman?
It's a really good question, and for better or for worse, we now live in a heavily regulated industry. To your point, we're not the only industry that's heavily regulated. We may feel persecuted at times that way, but that's our own issue to deal with. But if you look at the pharmaceutical industry, if you look increasingly at the energy industry and other major components of the economy, particularly in the United States, but increasingly globally, regulation is becoming a much more predominant theme. I tend to look at these things in historical context, and I think that when we study the 10 or 20 or 30-year period after the financial crisis, we'll look back and say it sort of made sense that in the aftermath of what was kind of the 100-year flood, there was a rush to regulate and put guardrails and barriers up heavily in the financial industry, but not just in the financial industry. So obviously there's been a lot of press around pharmaceutical pricing and the fact that that Mylan has the EpiPen and that they keep raising prices, and all of a sudden everybody goes in Congress goes very aggressively to try to restrict that, and you're going to see a lot more of that. So I think we're in a world where the excesses that have been perceived by the regulatory and governing bodies in the world are troubling to those bodies, and therefore they want to restrict them. So that's not, to me, abnormal, and it's sort of explainable. I think coincident with that, we're in a very populist kind of period in our history, not just in America, but you can certainly look anywhere else in the world. Brexit would be a good example of that in the UK. There are examples of that in Germany. It's kind of a wash in a lot of the European countries, and it's certainly a theme in the United States. And so I think the combination of populist rhetoric and populism that is propelling elected officials and those running for office to continue to focus on a more populist agenda, and a kind of normal regulatory backlash in the back of the crisis is kind of creating this environment that we're in. In terms of what Goldman Sachs is doing to deal with it, is we're just dealing with it, right? So there's a lot of people in our industry that I would say are kind of whining and complaining and saying, woe is me. And the fact of the matter is, that's not going to get you anywhere. We're living in a world where the governing bodies would like us to be safe. They would like us not to be risk takers. They would like us to be safe because they're worried that if we're too risky, the system will come down, as it almost did once before in the not too distant future. And so they're really trying to keep us on the straight and narrow, and I don't think any whining or complaining is going to change that. And I think this is a longer-term trend. I don't think this is going away next week or next month, and it's not. It may be convenient for us to think that one presidential cycle or one election is going to change it. I don't think it's that simple. I think this is a longer phenomenon in our society that's driven a lot by what happened in 07, 08. We are changing our behavior in a lot of ways. We're running our firm very differently financially. We take a lot less risk. We're much more heavily capitalized, so when we do a transaction, typically we'll have more equity in the transaction, less leverage. We have to run the firm that way. We focus a lot on reputational risk. So if you had somebody from the Federal Reserve here and you asked the Federal Reserve, what are you most focused on when you think about Goldman Sachs or JP Morgan or any of the major systemically important firms on Wall Street, the number one thing they would say, I think, would be reputational risk. It actually wouldn't be balance sheet liquidity because they feel like they've dealt with that already. Now they're worried that one of us does something somewhere in the world that is reputationally damaging. The Wall Street Journal, the New York Times, the Financial Times write negative stories about it for weeks on end. Our clients lose confidence in us, our regulators lose confidence in us, and our business erodes, and our firm erodes. And the thing I can tell you about our firm or any other firm in our business is, while we have lots of money and lots of capital and lots of capability, confidence, trust, reputation is critical. Without that, we can't operate. All of the rest of the stuff will erode. So they're very focused on that, and therefore we're quite focused on that. So our behavior, I would argue, has changed materially in the context of thinking about how what we're doing would be perceived in the external world, as opposed to how it just will be perceived in terms of the money-making opportunity in that narrow sphere.
We're going to bounce a little bit from macro to micro and back. So here's a micro question that really is relevant, I think, for the group that is assembled here. What are the qualities that you look for in the people that are hired and the people who succeed at Goldman Sachs? And maybe, only because we talked about this earlier today, as a backdrop, Goldman, even though it's public, still has partners, which are not legal the way they were years ago when before the firm went public. But this is a highly selective process, which John is intimately involved in. So as you answer that question, maybe think about it in the context of the people who will make it or may not make it in the coming weeks.
So my strong view on this topic, and I was an English major at Middlebury College, as the dean mentioned. That was my alma mater. And so I'm a liberal arts kid. I did not go to business school, which, sometimes I regret, but, you can't go back in life. But I'm a liberal arts person by training. And I've observed over the years in my career that you can't succeed in our firm, or I think in any significant and important institution in our business, without a mastery of the finance and the analytical tools that you need to have, whether you're a trader or a banker or in wealth management. There's a series of analytical tools that you must understand and appreciate. But most people in your position, if you don't know it necessarily coming in day one, can be taught that over time. And not over that much time, actually, because you're all very capable people. You wouldn't be here if you weren't. And we can teach you most of that stuff. Some of that stuff coming in, and the rest of it we can teach you. What is harder to teach over time as people get more senior and theoretically, as you said, more successful and more important to the institution, are the softer skills. It's communication, it's leadership, it's strategic thinking and direction on where to take a business and how to react to the environment around you. It's an appreciation for the global forces that are at work and a knowledge of what's happening around the world, as opposed to a more myopic focus on your narrow sphere. And I think those are the softer skills. I mean, another example would be taking a complex analytical analysis and distilling it in a meeting with a CEO or a finance minister or a head of state into something that they can appreciate and understand and make a good decision on, right? So we have a lot of really smart people that are mathematically inclined that can do the work, but it's much harder to take that piece of work and then walk into a meeting and in one sheet of paper or 15 minutes explain what the puts and takes are and how to think about the options and therefore the best answers and solutions in something that's explainable to everybody as opposed to the really smart mathematically inclined strat. And I think that is the skill that ultimately serves people that rise very far in these organizations the best. And secondly, and equally important, leadership. You know, we have a firm now with 34,000 people. We have hundreds of businesses that have to be run. They have to be managed. You have to have a strategic perspective. You have to manage people. You have to groom people. You have to create succession plan. You have to be very thoughtful about how to get the best out of everybody and manage a diverse group of people and be sensitive to those issues and help people in their careers. And that is not an easy skill that just comes from being analytically smart. That's a skill that's much softer and takes time to develop. So I think
let's dig just a little deeper on that then. Everyone in this room has got a pretty good IQ or they wouldn't be here.
Yep.
But talk about EQ for a second, emotional intelligence, because that's your
that's a good way to think about it. I think that if you came to Goldman Sachs, you would be in good company with high IQs. We tend to hire people with high IQs. I would argue, and I've argued this inside my own firm, that we are doing a suboptimal job hiring high EQs. Those are harder to figure out at the point of interview. But we're short EQ and long IQ is the way I think about it. It doesn't mean that I want to be short IQ, but I wouldn't mind being longer EQ, and I could probably suffer being a little shorter IQ to balance the balance beam a little bit more. And the reason I say that, and the reason I think Dan asked the question is actually when I think about my job today, 90% of what I do is really EQ. It's actually solving difficult people problems. It's figuring out how to think about a client's problem and figure out how to solve it and communicate it to them and convince them and persuade them what we think they should do. I've got tons of people that can do the high IQ analytics, and I need to understand it to be able to explain it. But I've got to figure out how to persuade a lot of people how to get things done. I've got to figure out how to persuade people internally as to what I think we should be doing or we think we should be doing. So the EQ is critically important. You can't succeed without the IQ and the finance background, but I think without the EQ, you won't go as far. So when we make partners, to finish on your question, we are very focused on the balancing of what we call commercial capability and contribution, which for a trader can mean being a really good trader and making a lot of money trading a government book or an equity book or a fixed income book or whatever it is and being adept at navigating in and out of markets. That's a commercial skill. But we have lots of people that are really good at that don't make partner because they can't do the other things. We couldn't give them a business to run. We couldn't have them run a desk. We couldn't move them to London and have them run the business in London. They can only really trade. So we pay them really well if they trade well, but we can't actually take them further than that. Similarly, in banking, we have lots of people that are really good at doing transactions, but we can't take them further if they can't run a group of people, think strategically about how we're going to make our equity business bigger and better, and so on and so forth. So we really try to balance what we call the commercial contribution with what we call LCV, which is leadership, culture, and values. So we want high value, high ethics, high leadership, high culture people, and those are more EQ-oriented skills than IQ, and so we're trying to balance. You can't have an organization that's all one way or the other way. You've got to try to find something that's in the balance.
Let's talk about another kind of balance, because I think one of the questions that a lot of people who are thinking about possibly going to work at a firm like Goldman or Wall Street in general worry a little bit about work-life balance. And can you talk a little bit about that, and how do people do it generally, and how do you do it?
So our industry, I think, is bad at this. Investment banking in the scheme of our industry is even worse than the average of the industry, because if you're a trader, or even in some cases in wealth management, you can tend to work more market hours because your client base is more market oriented. When you're in banking, your client base is a little less prone to operate on the market hours, a little more prone to operate on what their desires and ambitions are at that moment. And so you can tend to have a longer day. So we have, with the caveat that we're not very good at this, I would say that firm-wide, we spend an enormous amount of time focused on putting in place policies and procedures to limit and in some cases eradicate face time, to reduce the amount of hours spent on preparing presentations, on books, on materials that are really not used well or that are wasteful, using a lot of technology to give people the tools to actually really simplify and make more efficient tasks that used to take hours and hours and hours. We've done a lot of outsourcing to places. We've got an office in Bangalore in India. We've got an office in Salt Lake City in the United States. And we outsource a lot of work that otherwise Georgetown undergraduates or MBAs would be doing to people that are trying to get a start in the business, that don't have your background and training, that want to do some of that work. And we can have you do some more value-added work, which actually reduces your time spent working and also gives you the opportunity to do things that are much higher up the value chain, which is more earlier in your career, which is important. So we're doing a lot of things to try to improve the dynamic of what otherwise would be kind of a 60, 70, 80, 90-hour work week just because. We don't believe in the just because, and we've I think, been on the front foot and much more aggressive in our posture. We got rid of, for the analysts, we said no more Saturdays. You do not work on Saturdays. Now you can, your manager can apply for an exception. I actually approve the exceptions, so the exceptions are pretty rare. Now, if we're working on a $100 billion merger over the weekend, probably going to get approved. But you're probably happy to work on that. But if it's a client service book and it just happens that the person didn't think about it until Friday and they need to work on Monday, we're not going to approve that. And so we've done a lot to try to change. Some of this is really blunt force, and some of this is more using technology and becoming more efficient, and we're trying to do both. In terms of my own behavior, I've gotten much better over the years, mostly because I've learned that it's a marathon, not a sprint. If you want to be in this business and get to a senior level, you need to think about it over a really long period of time. It's an amazing career, but you have to pace yourself. And if you don't pace yourself, you will burn out, because it's the kind of place and the kind of job and the kind of industry where the demands can be great intellectually and physically. And if you don't find a way to make that work over a long period of time and fit it into the rest of your life and have a life, you'll opt out. No matter how much you think you love it, if you can't have a life, you will opt out. And so I have 5 children, and I spend a lot of time with my kids, probably not as much time as I should or as they want me to, but I think reasonably a lot of time given the demands of my job. It's in my calendar. So school plays, dinner. I put my kids to bed every night. I have some younger kids, some older kids. I put my younger kids to bed every night when I'm in New York, period. No movement in that. So my assistant knows in my calendar between 5:30 and 7, I am going to be moving to my apartment and reading bedtime stories and putting them to bed. That doesn't mean that I'm going to be stopping my work at 7. I'll probably go to a dinner. I'll probably be in my home office doing work. But that's a kind of a sacred period. And I think you have to carve out time in your calendar, and it can't be I'll get to it. It has to be like the importance of a board meeting. So I'm pretty diligent about that. And then I don't go to the office on the weekends. When I was in your shoes, I obviously did. As I got more senior, I was pretty religious about not going to the office on the weekends and just making that sacred family time. And so how do I make up for it? I'm available. I respond to BlackBerries or iPhones. I do still have a BlackBerry. I'm getting rid of it soon. I respond, instantaneously, other than when I'm in a board meeting or being interviewed or something. And so my behavioral trait is I'm very responsive, very available, but not physically always available. And so my kids know that sometimes I have to step away and take a phone call, but they know that I'm on the soccer field, I'm at the school play, and I'm committed, and that's the way I try to manage it. But it's a constant battle.
Full disclosure, we played golf this morning, so he doesn't work 24/7, and he beat me on top of it, which is really discouraging. But
please don't tell my boss I played golf this morning.
Let's shift gears just a little bit and talk about the competition. A lot has changed in the last 10 years. Goldman Sachs and Morgan Stanley became chartered as banks. A lot of firms, one of which you worked for a while, is no longer in existence, and it's become so much more global. Can you talk about how that's affected behavior and how Goldman competes today relative to the way it may have been years and years past?
I think the best way to think about it is akin to what I said in the beginning of your first question, which is that you kind of have to think about this pre-financial crisis and post-financial crisis. I worked at Bear Stearns in the early days of my career, and there were half a dozen firms, Lehman Brothers, DLJ, even Merrill Lynch you could put in this category, that were pretty pure play investment banks with some trading businesses and some wealth management, but they were pretty pure play firms, not big balance sheets, not big risk takers, more of what I would call an agency business. And even Goldman Sachs in those days was more that way. What happened is the balance sheet aspect of these firms became much more important. The provision of capital, the lending, the ability to create opportunities off your balance sheet became a much bigger part of Wall Street. So the old-fashioned M&A, equity underwriting, debt underwriting, still important businesses, didn't really grow that much, and the capital businesses grew a lot. The balance sheet businesses grew a lot. Structured products, derivatives, the way I think about it is provision of capital, lending, intermediating flows. You had an explosion of liquidity in the world, a lot of it outside the United States, that wanted to get allocated somewhere in the world and needed somebody to help them intermediate that. And that became a much bigger part of Wall Street than the regular way stuff that we all think of when we think of Wall Street, at least that I think of when I think of Wall Street. And so the competitive landscape has shifted to the firms that can do that best survive and thrive. The firms that can't do that go away. And the financial crisis hastened that going away part because it created the 100-year flood. And so it was kind of like what Warren Buffett says, when the tide comes out, you realize who's swimming naked. And that's what happened. So the Bear Stearns and Lehman Brothers didn't have the ability to do that. And because they were trying to keep up, they were actually taking more and more risk to keep up. So I would argue Lehman Brothers and Merrill Lynch, as two examples, were kind of trying to become Goldman Sachs and JP Morgan. And so they were taking on more risk and trying to run faster, and they got hurt. And so now the competitive landscape is such that if you don't have a big balance sheet and an ability to take risk and provision capital and intermediate for these major capital pools globally, you can't survive. So who's doing well? JP Morgan's doing well. Goldman Sachs is doing well. Bank of America is doing well in a more United States-centric manner, but still doing well. Citigroup, amazingly, after having had a really tough financial crisis, is doing pretty well. The Morgan Stanley is having a tougher time because Morgan Stanley is a little bit of a tweener. So I would say Morgan Stanley is a firm to watch. It wouldn't shock me if Morgan Stanley ends up doing something, some strategic transaction. This is, I assume, a closed meeting, so you guys won't run to the newspaper and say that. But they're a little bit of a tweener. And then you have the European banks. And the European banks, as Dan and I were talking about earlier today, are really in a tougher place because they never recapitalized themselves the way that the United States banks did. So when the financial crisis happened and there was that kind of series of messy weekends leading up to the TARP, where Hank Paulson and Tim Geithner and Ben Bernanke basically forced the banks in the United States to take capital, and everybody was kind of like, wow, that's ugly and messy and unprecedented. It did kind of save the system, and it did actually create a lot of capital buffer in the system. And then the banks went on from there with the Fed and other regulatory bodies to actually create a lot of capital. That never happened in Europe. So the European banks to this day are still undercapitalized and run a lower profitability, lower ROE business, and therefore have a much tougher time. So the next time, knock on wood, there is some kind of a crisis, the European banks will be at the tip of the spear. And I wouldn't be shocked if we read about some European banking crisis sometime in the future because they have not fixed their problems. And so the competitive landscape is really now more dominated by the healthy American banks. And I think what will be interesting to see is in the next 10 to 20 years, during the pendency of your career, I may be gone by this time, but during the pendency of your careers, the Chinese banks, the Brazilian banks, and some of the other major international players will probably become more relevant than they are today in the careers that you guys will have. And you'll have to figure out how to deal with them more than I have had to figure out how to deal with them.
Let me ask you one more question, and then we're going to open it up to the audience for questions. And it sort of has two parts, and it's a little bit more of a question that pertains to the group that's here. For a long time, and this is a question actually was submitted by a faculty member, which I really liked. For a long time, Wall Street really attracted the best and the brightest. And I think that over the last number of years, because of media attention and government involvement, et cetera, a lot of people might be asking, are these careers still worth pursuing on Wall Street? So that's sort of the first part. The second part is, the different types of competitors you have for talent today. On the front end, companies like Facebook and Google and that kind of thing, and even after some go to Wall Street and work at places like Goldman, other opportunities crop up like hedge funds and private equity and those things for people that are sort of midstream in their career. And if you could talk about that, it would be great.
Yeah, so we're in an age where there's going to be more automation, there's going to be more machine intervention in our business. It's more prominent on the trading side of our firm. So in my business, it's less prominent. But if you had my counterpart who runs our trading operation, and you asked him what was most prominent in his life right now, he would say technology, automation, machines, strats, analytical capability that is more machine-like and that will continue to reduce the number of people in their business and make it more technologically driven. It's not so much the case in banking, although it is the case more than it ever has been. And so we are shifting that direction. The reason I start by saying that is we're going to probably have fewer people on Wall Street over the next 10 to 20 years. Not probably. We will have fewer people, in my judgment. And you'll see more things that were otherwise done by people done by machines. Having said that, particularly pertaining to my business, there is no substitute for great people dealing with clients. I don't yet know how we're going to substitute a machine for a person to sit with a CEO or a finance minister and have a meeting on a really important topic. I don't think we're going to be able to do that. I don't want to do that. And even if I don't want to do it, I'm not really sure how it's going to be done. It doesn't mean that there aren't things that can be done that way. We can now put an app on the desktop or mobile top of a client to do a currency swap and basically give them that app for free, give them the analytics and have them manipulate it and decide what they want to do with it and how they want to prosecute it, and hopefully call us to execute it. So that's something that we will make less money likely doing all that, but we'll be more efficient in doing it, and the client will like it more, and it may engender more loyalty and more trust and so forth, and we may build an application platform that we can monetize somehow. But there's going to be more of that. But there is no substitute for the heart surgery of our business, which is, AT&T, Time Warner, right? Got to sit there with Randall Stevenson at AT&T and help him understand how to do that and how to get it done and how to get it done quickly before the press finds out, and then when the press finds out, how to get it done quickly before Google decides to do it instead of him. So that is still going to be a skill in demand, and therefore I still think that we will have the same need we have today for hiring the very best people at schools like this. We may hire fewer of them because the overall pie may be less, we may be less needy of the numbers, but we're still needy of the skill and the talent. Now, as Dan says, we're fighting that war with way more people than we ever did. So when I was coming out of school, it was, you wanted to go to McKinsey or Goldman Sachs or maybe Procter & Gamble. Those might have been the gold standards at that time. Today, you all know better than I do, there's tremendous opportunities all over the place. Why do I still think it's really interesting to come to a place like Goldman Sachs? Because I think that we have a breadth of vision on what's happening in the world that is unmatched. If you go to Apple or Google, you're going to do some extremely cool things. But you're going to do it amazingly in a narrower sphere than what you're going to do at Goldman Sachs, because we see every industry, every trend, everything around the liquidity in the world, around strategy in different industries. You want to know what's going on in shale gas? We can tell you what's going on in shale gas. You want to know what's going on with Snapchat? We can tell you about Snapchat. We can tell you about what's happening in the spirits industry. We can tell you about the insurance industry. You pick it, we will tell you what's going on, and you will have access to massive information all around the world. And I think early in your career, that breadth is really important. I can certainly appreciate later in your career, as you want to get more specialized, you may want to dive deeper into something and become more of an expert on something more narrow. But to me, in the earlier part of your career, I still think it's hugely valuable to have a global perspective that's broad across the world, markets, industries, politics, government, regulation, environmental policy, you name it, we deal with it. That's our lot in life, for better or for worse. We've got this kind of broad distribution around the world, and we deal with all of those elements, everywhere. And so I still think that's a pretty compelling thing for somebody that's your age to think about, kind of getting that education on our nickel, and really getting to travel the world that way. That's sort of how I think about it.
Let's open it up to the audience and get some questions from all of you. We can start with this gentleman right here.
Thanks a lot
There's a microphone coming to you.
Thanks a lot for coming. Really appreciate the things you've said. I have an older brother who's trying to convince me not to pursue a career in Wall Street, specifically in M&A, investment banking. His reasoning is that the majority of M&A deals end up not creating the value or the synergies that were forecasted. And so you end up kind of destroying value, if you like, and he would rather me go into a practice where I create value. Can you offer any rebuttal to his point?
So it's a really interesting question. There is actually a lot of history and analytics on this topic. I've heard this perspective from a lot of people. If you actually go look at the analytics would not support your brother's statement. If you compare, now it doesn't mean that he's not right in a lot of cases. I mean, I think the way I think about this is it's vintages, right? I don't think it's easier to sort of think about it as vintages. The vintage of 2004 to 2008 was a heavy M&A vintage, defined by leverage, private equity, cash, and not particularly synergistic or strategic. Not focused on cost or synergy, more focused on, can I convince them to sell me the company with a lot of leverage so I can make a return? And that ended poorly. We're still, I can't give you the final judgment on it because we're still living with the sins of those transactions, and some of them will end up better than we might otherwise have thought because interest rates were low and a bunch of these companies were able to avail themselves of liquidity longer than you might have guessed. But nonetheless, it won't be a good outcome broadly. So he's probably right about that vintage. My argument in the current vintage would be the opposite, which is most of what we're doing right now is in-market, corporate consolidating transactions in an otherwise very low growth environment. So if you're running a company, your top line growth is 2%, and your stock trades at 20 times earnings because money is free, and the stock market's really high because money is free and there's no other good alternatives, and so values are really high, but you have very little growth. You've refinanced everything you can refinance. Your margins are at all-time highs. You have turned all the easy dials. You bought back a ton of stock. You've got tons of cash. And your industries are changing, right? There's a lot of competition from China. There's dynamic and change all over the place in these industries. That's fueling a huge amount of M&A. I would argue we're going to look back on this and say that was actually pretty intelligent M&A. It doesn't mean it won't go too far at the end, that the last 25 deals won't be bad. But in the scheme of what's going on in these industries, and I'm talking my own book, but I'm allowed to live in this dream right now, these companies have very little choice but to take cost out. It's just not one of those environments where you can say, oh, it'll be better tomorrow and there's going to be more growth and we can kind of make it happen. They've got to take cost out. They've got to be more efficient. They've got to compete with the Chinese, and they've got to find a way to create value. So I would argue this vintage will be more value creating than the last vintage, and I can take you back through history that way. So I think you got to think about it that way. What I would say is it's pretty unfair, I think, to paint the whole thing with one brush. You wouldn't see as much M&A if there was that much value being destroyed. Shareholders are very supportive of it. They know what's going on in these companies standalone. So that tells you a lot. There's a lot of smart people that are very supportive of this M&A, and that's not because they're altruistic or they're running a charity. So they think there's value being created. And what I think is really cool about being at a firm like ours is you are in the middle of the action. You pick up the Wall Street Journal, you open it, you look at the 10 things going on. 7 of the 10, we're somehow around it. So to me, there's a relevancy to that. You can argue and debate whether any one of those deals is a great deal or a less good deal, and you won't know for 5 or 10 years usually. But there's a relevancy to being in that narrative and in that conversation and that dialogue, and having people in the world that are important want you in those rooms. And that, I think, that's what keeps me there. That and the people. And at the end of the day, I think that's the reason to want to pursue, to your example, a career in M&A, because you're very relevant at our firm doing that, and it's relevant to what's going on in the world. The trend in the world right now is to consolidate. We can look back 10 years from now and debate whether it was good or bad, but that is what's going on, and there's a relevancy to that.
How great is it going to be to shut your brother down like that? It's going to be fantastic. Next question. Yes, ma'am. Oh, microphone.
I can repeat it if you, that's fine.
Thank you for coming today. I was just wondering how the business principles influence your leadership approach in investment banking.
So it's a really good question. We have a set of business principles we've had for a very long time. There was a former head of our firm named John Whitehead, who was a mentor to me and many others at the firm, and somebody really to be looked up to for lots of reasons, including the fact that he served a lot of time in the government and gave a lot back to the country, ran the 9/11 Commission, et cetera, et cetera. He was very focused on our business principles and articulated a set of principles and philosophies about how we ought to behave and act. And many, that have come after him have really helped us solidify those. I would argue during the financial crisis, we got a little bit away from some of the business principles, and that's partially how we got a little bit off track. So one of the things we've really learned is that if you don't get to true north on those business principles, you can get off your course. And there are some good reasons for why it happened, and some of this stuff is just the macro environment, and you can't escape it. But putting clients first, not your own self-interest first, that's mission number one in our business. So one of our major principles is we are here to serve clients. Clients have a problem that they need solved. We're here to solve the problem. That's our job. If it's not in our selfish interest to solve it the best way for them, we still do it. So sometimes we think the right thing is to not do a transaction, but we're not going to earn a fee. We still say don't do the transaction. Some of my best relationships in my career have come by telling people not to do things that 2 years forward they say, wow, I'm so thankful that we didn't do that. But that was economically a bad decision for us at the moment, but longer term is a better decision. So a lot of it is putting the client's interest first. A lot of it is how we treat people, the way we respect ourselves and our own internal behaviors. The Wall Street's pretty well known for having kind of a crazy culture at times. We're very respectful of each other. We disagree, but we do it in a very respectful manner. There's not a lot of yelling and screaming at Goldman Sachs. There's not a lot of throwing phones. There's not a lot of the stuff that you would have thought or heard of around Wall Street. We're very respectful of each other, and that's part of the way we want to behave. And we think a lot about our reputation, as I said earlier. So a lot of this is how do we want to be perceived in the world, the relevance we have, what we do for society. So one of the things we've done on the back of the financial crisis is we've become much more focused on our social mission. Now, admittedly, some of that is helpful vis-a-vis our external branding. But I would argue we're getting a lot more value out of it in the terms of the way our constituencies externally, clients, most importantly, governments, other major constituencies that we care about, are viewing us differently in terms of the impact we're having in the world. We started something called 10,000 Women. 10,000 Women is basically our attempt to create an entrepreneurship MBA, a one-year MBA, for women entrepreneurs in very challenging places in the world, Nigeria, Thailand, Vietnam, India, et cetera. And we're having a huge impact. We are serving an enormous, we are going to serve more than 10,000. We're going to serve 20, 30, 40,000 women, putting them through a one-year MBA, learning how to balance their books on their businesses, and putting them on sound footing. And that's huge. That's really important. We're doing the same thing in the United States, 10,000 small businesses. We're partnered with Michael Bloomberg and a guy named Michael Porter at Harvard, focusing on entrepreneurship in the United States, affiliated with different universities, and really trying to build entrepreneurship in this country. And so those are business principles, which is to give back, to be relevant and important, and to use the skills and the capabilities that we have to be important in society, not just making rich people richer. And so that's part of how we're trying to think about ourselves in today's world.
Yes, question back there. Microphone coming to your left. There you go.
Hi, thank you for being here, Mr. Waldron. I'm wondering, so Goldman just made, Goldman, which has historically been a pure play investment bank, just made a move into consumer finance with a personal lending service. I'm wondering what the impetus was behind that. Why change 125 plus years of history?
So you're absolutely right. We launched something about 2 weeks ago that is branded Marcus by Goldman Sachs, named after one of our founders. And the impetus for this is, from a business standpoint, as I said earlier, we're in a very regulated environment where it's very hard to make excess returns. So we're looking like every public company looks for growth. And one way to create growth is to build another business line that allows us to create some growth channel that is different from what our other businesses are. So that's part of the business impetus, is to find another way to grow. Similarly to that, because in the financial crisis became a bank holding company, we now are a bank. Right? Goldman Sachs for a long time was really not a bank. It was really a merger advisor, a trader, a wealth manager. We weren't a bank in the traditional sense. Now we're a bank. For a lot of years after the financial crisis, we didn't really use the bank. We just were a bank and had the privilege and pleasure of the Federal Reserve in our office all day long, but we actually weren't doing anything with it. So now that we're a little further afield from the financial crisis, we're trying to use our bank intelligently, and one of the ways we're trying to use our bank is to lend more money. One of the ways we can lend more money is in the consumer world. However, we don't really want to build a bricks and mortar consumer business and try to compete with, the other bricks and mortar consumer businesses. So the opportunity that technology brings today is to be a disruptor and do this using our bank and our deposits without having bricks and mortar and being much more technologically and efficient and focused on delivering a good product, but doing it in a much more profitable way. So that's the way we think about it. We're very excited about it. It'll be a long build. It's not going to impact the Goldman Sachs financial statement anytime soon. And there's a real risk to our being in the consumer business. We're not a Main Street firm. We're an institutional firm. We don't have a Main Street brand. We don't have a relationship with Main Street per se. So this is something that we're doing from lots of vantage points. Part of it's business and financial, and part of it is creating a Main Street connectivity that we think will be a good thing because we're really going to help people solve credit card. This is really an unsecured lending business, effectively to help people manage high credit card debt that's a 18, 20, 22, 24% kind of APR credit card debt. And we're going to offer a single product, which is basically a fixed rate loan that'll be more like 11, 12, 13, 14%. Still a high rate, but not 20+%. And a pretty simple 3 or 5 year loan that gives you the chance to kind of manage your financial picture more intelligently. And we think that gives us a connection to Main Street in a good way that helps us build that brand.
Question over here. Yes.
Thanks for your time. This kind of touches on the previous question, but it seems to be a lot of risk aversion on Wall Street. However, a lot of innovation and growth is driven by risk taking. Is there room left on Wall Street for growth? And if so, what kind of risks is Goldman taking to grow in the future?
So you're right. It's a similar vein to the prior question. I would say you're absolutely right that there's less risk taking on Wall Street, and that therefore it's much harder to create excess returns. And you can thank the regulators for that. That's not because we don't like risk. It's just very hard in this world to be stepping into extra risk positions and trying to create big opportunities. And you're not going to take lots of leverage risk to do that. So that therefore means that to me, the incremental growth and innovation on Wall Street will probably come from technology and will probably come from financial technology. It will be in the trading business. We're doing a lot of things in the trading business that I'm not talking about. A lot of apps that are being built, some of which has been reported in the Wall Street Journal. And so we're doing a lot of things that I would call quite innovative in terms of giving our clients what otherwise would have been proprietary technology and capability that we have, and making it kind of open source, open to the world, and trying to do that in a way where we build platform. So that'll be innovative, and it is already. And Marcus, I think, is an innovation and a disruption, not that different from Lending Club in some respects, with one major exception, which is it's our balance sheet. So Lending Club is an example for those of you who know. Lending Club is a securitizer. They don't really have a balance sheet. They're like an agent in the middle. We're using balance sheet, which gives us the ability to be much more sustainable and ride through the market cycles. So I think your question is spot on, which is the innovation is going to come more on the technology side, and it's going to be incumbent upon our firms to be pushing the envelope there. The risk taking will be there. It won't be on the balance sheet, kind of traditional risk taking side. It'll be much more building new businesses, new platforms. And I would say right now, Goldman Sachs and JP Morgan are probably the two firms that are most out there in terms of trying to do that. Not surprisingly, because we probably have the best businesses and therefore the best platforms to jump from, right? We can afford to go spend some money and do this and try to grow and build. We don't have to defend our position as much as some of the other firms do. So that's the way I think it's going to play out.
Let me take a couple more questions. I thought there was another one. It's sort of hard to see here with the lights on, but yes. Yes, sir.
Hi, I'm Jayesh. Thank you for coming here. So my question is regarding the political scenario right now. So how is that going to affect Goldman or Wall Street in general, and do you think, are you prepared for any kind of,
Our job is to be prepared for all scenarios. As my boss, our CEO says, we're in the risk management business. So despite what I just said, we still are risk managing, and we have to be prepared for all scenarios. So yeah, we think we're prepared. I think the easiest way to think about it, if you talk about the presidential election, the easiest way to think about it is, I think the markets think they understand what a Clinton administration would bring for the most part. And it doesn't mean that administration would bring the same thing that the Bill Clinton administration brought, but they think they understand kind of what the Hillary Clinton template would be, which would include some regulation. I don't think the pharma companies are that anxious to have Hillary Clinton as president. But broadly speaking, I think that there's a sense that there's a guardrail around what that would look like. The Trump phenomenon is so much harder for anyone to get a handle on, so that what you're seeing and reading in the press is that the markets may go a little haywire for a period of time because nobody quite really knows it's a white sheet of paper. It'd be very hard for anybody to give you an intelligent answer as to what really is that platform and what really is the agenda, and what really he'll pursue and what really can get done. Whereas I think a Clinton-Ryan dynamic is more explainable and understandable. You can debate what will get done or not, but it's more explainable. I think actually the thing that's more relevant to us, maybe less interesting, but more relevant, is the congressional arrangement. So, and principally the Senate, because it doesn't feel likely that the House will shift. The Senate is on a knife's edge as to whether it will or won't shift. And what you find in our job, in our industry, is the legislative impact that affects us is typically felt in Congress, not with the president. So while the president is obviously the most relevant person, typically actually most of our lobbying and most of our time spent is actually, when I come to Washington, I obviously don't meet with the president, but I don't meet with anybody in the White House. I go to the Hill because that's where actually the real games are that will impact the playing field we're on. And I think that that's a more relevant factor. So if the Democrats win the Senate and Hillary Clinton wins the White House and the Republicans lose a lot of seats in the House but maintain control of the House, that is a riskier proposition for us than other scenarios. And so that's a more relevant, I think, challenge.
Another question? Yes, ma'am.
Hi, thank you for being here today. So what part of your undergraduate experience did you find to be the most influential or beneficial during your first few years in the professional environment?
So it's a really interesting question, and I've changed my view on this over the last 5 or 10 years, certainly over the last 5 years. I would say history. And some of the political science, international relations classes that I took were probably the two most kind of relevant components. And that's because you find that understanding the history as you travel around the world, the cultural history, the foreign policy history, the market history, is quite relevant to understanding why things are the way they are and how they got to the way they are and how they might evolve over time. I didn't appreciate that when I was earlier in my career until I got to a position where I was in charge of running global businesses and had to go travel around and figure out, why the Germans and the French have the relationship they have and how Europe works or doesn't work and why is that the case and how might it evolve over time. And so that history, which sometimes repeats itself, sometimes doesn't, is really important to understanding, I think, what's happening in the world and where it might go and how to explain it to people. So that's important. And obviously the political science, international relations is a consistent theme for the same reason. I think politics and markets are inextricably linked, always have been, always will be. And I think to the prior question, to understand what's going to happen in this election is to understand and have a view on what may happen in the markets. And that's our job. Our job is I was in China 2 weeks ago, and I couldn't get past the first 5 minutes of the meeting without having to talk about Donald Trump. The next 20 minutes was about, okay, well, so we've had the fun of talking about Donald Trump. Now, what does it mean, and what's going to happen? And so to understand and explain that, you have to, I think, have had a fairly reasonable understanding of kind of historical context and what those international relations, may bring. So that's definitely been, to me, the most relevant factor.
I think it was Churchill that said, the further you look into the past, the greater your ability to see into the future.
That's right.
So let's take one more question. And this side of the room has been massively unrepresented, so how about one more question from over here? Yes, sir.
Hey, how's it going? My name is Johnny Kim. I'm a junior in the business school here at Georgetown. So as someone trying to enter the financial services industry, a lot of people say, oh, Johnny, work for an American bank and not a European bank. And you kind of touched on that. I'm sure this topic affects you and also maybe your clients, but how much does it affect me as someone trying to go and enter in the analyst level?
So you're saying, meaning working at an American bank would be viewed as a negative?
As a positive at the moment.
As a positive.
Yeah.
Oh, yeah, listen, I think it's funny how things evolve. I lived in London from 07 to 11, and at that moment, working at an American bank was not viewed as a positive. Working at Goldman Sachs in particular was not viewed as a positive. And it's changed a lot because, in my opinion, while there's been a lot of things that have happened in our industry that are not great and not helpful for reputation externally, the fact of the matter is the American banks are much more successful right now than the European banks or any other banks for that matter, in terms of their relevance, their capital, their capabilities, their breadth, their global network, and so forth. And as I'm often reminded by my boss, you can say what you want about all this other stuff. Success matters. If you're really important and really successful, your relevance is there. Now, you have to behave properly, and if you're successful with poor behavior, that'll have its issues. But if you're successful and relevant, you're going to have a lot of people that are going to look to you and have a favorable view as long as you're behaving properly. And right now, the Goldman Sachs and JP Morgan right now have a real distance with everybody else. And if you said to me, what is the single toughest competitive threat you face, it's actually not JP Morgan, because we're kind of, it's almost like a Cold War. We've kind of got mutually assured destruction. We go at it all the time, but we're both doing really well. It's actually the international banks or technology or somebody else coming into the stage that we can't see right now. I don't think it's going to be Citigroup or B of A or Paribas or Deutsche Bank. I think it could be some technology startup that hasn't happened yet that 10 years from now becomes the Amazon of our industry and really disrupts us, or a Chinese bank that decides that they figure out how to get a lot of capability over 10 years and become a much bigger threat with lots of capital. But right now, the American banks are where the success lies, and that's why I think the reputation is the way it is.
John is going to stick around for a little while. There's a reception that will follow this session. And I'd like to ask you to join me in thanking John for coming to Georgetown. And
John. As with Dan, I want to thank both of these gentlemen, in particular Dan here, for spearheading the series and having the foresight to see how valuable this is to our students. And I sat in the front row and had a nice seat to hear all this valuable advice. This is wonderful, and one of the things we try to do here at Georgetown and develop our principal leaders. And for John over here, so there's going to be a reception following, but I probably will guess that about 10 minutes or so to 8, he'll get out of here because he's a Cleveland Indians fan, and he's got to make sure that they bring home the double titles for this year, one in basketball and one in baseball. But I really want to thank both of these gentlemen for this valuable experience, and thank them for spending their time here at Georgetown. And just a quick gift here to John, and let him know this is a token of appreciation from Georgetown. And once you've been at Georgetown, you get a gift, and you become a Hoya forever.
That's great.
Okay,
Thank you very much.
Thank you very much.
I really appreciate it. Thank you. Thanks. Appreciate it.